All right, moving on to disability income insurance. This is a very important concept. A disability income policy is only designed to replace lost income. And the reason that's important is that if you have a disability income policy and then you get in a car wreck and you're hospitalized and have to have a bunch of surgery, it will not pay your medical expenses. It is only designed to replace lost income. Let's look at some provisions found in a disability policy. First, presumptive disability is a provision that is found in most disability policies, which specifies conditions that would automatically qualify the insured for their full disability benefits, such as permanent blindness, permanent deafness, or even loss of 2 limbs. Those are 3 I've seen on the test that can qualify under presumptive disability. It must be permanent blindness, it must be permanent deafness, or loss of at least 2 limbs to qualify. Next is recurrent disability. It's another provision. It specifies a period of time during which the recurrence of a prior period disability will just be considered a continuation of that prior period. Now, it has to be 2 similar disabilities to qualify under recurrent. It can't be 2 completely separate disabilities. It has to be similar disabilities. All right, next let's look at some different periods in your disability policy. First, there is the elimination period. All the elimination period is a deductible that's measured in days, not dollars. Your elimination period begins from the onset of your disability. You get to decide how long of an elimination period you would want in your disability policy. It could go anywhere from, say, 0 days up to 1 year. Now, the longer your elimination period, the lower your premium is going to be. Okay, it's kind of like having a high deductible. So the longer the elimination period, the lower the premium. Now, there's another period in a disability policy that the insurance company might put in there called a probationary period. The probationary period is put in there by the insurance company. It's a period of time from when a policy is first issued that must be covered before an illness will be covered. So it's a period of time from when a policy is first issued before an illness would be covered. Another word for illness is loss or certain losses. It's usually between 10 and 30 days. Now, it's put in there by an insurance company to help prevent, and these 2 words should sound familiar to you, adverse selection. Remember, adverse selection is sick people trying to commit fraud. If you are just buying a disability policy and you're sick because you're sick, well, any claim you might try and file during the probationary period will not be covered. They're going to say that's pre-existing. We are not going to cover. Okay, doesn't mean it'll be covered after the probationary period. They're just going to say, sorry, you're a sick person trying to commit fraud. We ain't covering it. Okay. Now, if you were injured, let's say you fell down and broke your leg, that has nothing to do with the probationary period. It's only illnesses. Okay, so any kind of accident or injury could begin the elimination period. And the last period is the benefit period. Now, the benefit period is when the insurance company is actually replacing your lost income. Now, for your test, it is important that you know that disability benefits will have to be paid at least monthly. That's required by law. So if you'll write that down, disability benefits have to be paid at least monthly. Now, on an individual disability policy, the benefit will always be tax-free to the insured. On a group disability policy, it will depend on who pays the premiums, and we cover that in a taxation video from earlier on. Now, the longer your benefit period, the higher your premium would be, because the longer the insurance company would have to replace your lost income, the more you would pay for that policy. All right, next let's define injury in a disability policy. There's two different definitions. First, there's the accidental bodily injury definition. Accidental bodily injury means the damage to the body must be unexpected and unintended. Or there's the accidental means definition, which means the cause of the accident must be unexpected and unintended. Here's how I need you to know it for your test. Please memorize this. The accidental bodily injury definition, more liberal of the two definitions, provides the broader of the two coverages. Accidental means definition, actually more strict of the two definitions, and it's been outlawed in most states. So that's how I want you to know it for your test. Accidental bodily injury, more liberal of the two definitions, provides the broader coverage. Accidental means more strict of the two definitions, actually been outlawed in most states. All right, now let's look at a disability policy in a business setting. First, there is a business overhead expense policy. This is a type of disability policy purchased by a small business owner. However, if that small business owner became disabled, it would not replace his income. However, it would cover the overhead expenses of his business, his rent, his salaries, his lease agreements, his utilities. It will keep the lights on and the doors open, but it does not replace his income. Now, very important, and we covered it in our taxation video, the premiums are paid by the business owner, and they are deductible as a business expense. However, if that business owner becomes disabled, any benefit received by the business, once again, rent, salaries, utilities, lease agreements, is taxable to the business. So a business overhead expense policy, premiums paid by the owner, deductible as a business expense, benefit received by the business would be taxable. All right, these next two, key person and buy-sell agreement. Okay, first on a buy-sell agreement, or let's first start with a key person policy. Key person, remember, key person is someone that has specialized knowledge, skills, and business contacts. So the business owner could purchase a policy on their key person. So if that key person became disabled, it would provide the business owner funds to hire and train a replacement. Now, the contract is owned by the business. The premium is paid by the business or the business owner. And then the business owner is the beneficiary. And the benefit will always be tax-free. So that means that the premiums that business owner paid are not deductible as a business expense in this case, because the benefit received by that business owner is always tax-free. And then on your buy-sell agreement, just real quick, buy-sell agreement is set up by business partners. Remember, how's that business going to change hands if one of those business partners were to die or become disabled in this case? For taxation purposes, premiums paid by the business partners are not deductible as a business expense because any benefit would be received by the other business partner is always tax-free. All right, group disability. Group disability would only replace a percentage of a worker's income. Once again, it's not going to replace all of their income or they'll never go back to work. Now, it could be long-term, short-term, it doesn't really matter, but I do need you to know for your test that in group disability, it's always going to be written on what's called a non-occupational basis only. Non-occupational means anything that happens off the job. It will not cover them if they get hurt on the job, because if they get hurt on the job, they always have workers' compensation to cover them. So group disability is off the job only. Very important for your test that you know that. Next, we have accidental death and dismemberment. Could be a rider to a disability policy or a standalone AD&D policy. But same thing you learned earlier about AD&D. There's the principal sum, which would be paid for an accidental death. And make sure you know for accidental death, death must occur within 90 days of the accident. It would also pay that principal sum for a double dismemberment, permanent blindness, or permanent deafness. Now, there's also the capital sum, which is going to be a percentage of the principal sum, but that's only going to be paid for loss of one sight in one eye, loss of hearing in one ear, or loss of one limb. So it's only one of something. Other types of policies, there's limited risk policies, which would just cover specific risk. Travel accident policies, and that's an important concept on travel accident, because if, let's say, you are traveling overseas, you're outside of the United States, and you have a disability policy here, but let's say you're surfing in Bali, for instance, and you fall off your surfboard and break your leg. Any policy you have here will not cover you, because overseas travel and residence is excluded from your health policies. So that's why you would have to have a travel accident policy. Then there are special risk policies. So let's say you're a race car driver or a bungee jumper. It would cover just that special risk. Okay, now let's talk about long-term care policies. So long-term care policies provide coverage for individuals who are no longer able to live an independent lifestyle and require living assistance at home or in a nursing facility. When you purchase a long-term care policy, it's like purchasing a disability policy in that there will be an elimination period and a benefit period. Long-term care benefits will be tax-free to the insured unless the benefit exceeds the daily cost of care. So let me give you a quick example on that so you can kind of see how it works. Let's say you have a long-term care policy and it has a benefit of $200 a day if you got confined to a long-term care facility. Let's say you get confined to a facility and the cost of care is $400 a day. You're going to get $200 a day because that's how much you purchased. Those benefits are tax-free. What if, however, you got confined to a facility and the cost of care was only $100 a day? You're still going to get $200 a day because that's how much you purchased. Now, 100 of it is the cost of care. That's going to be tax-free. However, there's an extra 100 that you received, which is taxed like income. So long-term care benefits are tax-free unless the benefit exceeds the daily cost of care. Now, long-term care policies have exclusions like pre-existing conditions, mental and nervous disorder, treatment covered by Medicare, Medicaid, workers' comp. But there's things that cannot be excluded. That's why I have it here. Things that cannot be excluded would be Alzheimer's, dementia, and Parkinson's. Those cannot be excluded from long-term care policies. Alzheimer's, dementia, and Parkinson's. Now we're going to look at the different levels of care in a long-term care policy. A couple of things to take away from each one of these are who can provide it, and then where can it be provided. And I'll point out each one, what you need to know. So the top level of care is called skilled care. Skilled care is care that can only be provided by medical personnel, and that care can only be provided in an institutional setting. So it must be medical personnel, and it must be in an institutional setting. The next level down is intermediate care. Intermediate care is also care that can only be provided by medical personnel. However, that care could be either in an institutional setting or in the patient's own home. Intermediate care is for people who need help with any nursing or rehabilitative care. Next level down is custodial care. Now, custodial care is care that can be provided by non-medical personnel. So this is the first one that's non-medical. And that care could either be provided in an institutional setting or in the patient's own home. Now, custodial care is for people who need help with their activities of daily living. They're eating, they're bathing, they're dressing, they're transferring, which means moving from one place to another. That's why it can be non-medical personnel that provide it. Next, we have home health care. Now, home health care is care that's going to be provided by a skilled nursing company or other professional service in one's own home. So it's important that you know it has to be some type of skilled nursing company, or the only other way would be a community-based organization like hospice could provide home health care. 5 minutes ago, if I would have asked you what the word residential meant, what would you have thought? I bet you would have thought it would have meant home. Well, guess what? Residential is not home. When we're talking about residential care, we're talking about a senior that's unable to live an independent lifestyle and they've had to move out of their home into a residential retirement community where they can get all their needs met. So make sure you know residential does not mean home. Next is adult daycare. This is care for functionally impaired adults on less than a 24-hour basis. Care could include transportation to and from a daycare center. Meals are usually part of the service, and then you get social related activities. So on your test, make sure you just associate adult daycare with less than a 24-hour basis. And lastly, we have respite care. Respite care is designed to give relief to a family caregiver. So that caregiver can take a nap, take a walk, just get out for a while. So respite care can be part of a long-term care contract. All right, moving on to group health insurance. Group health, similar to group life, they underwrite the group as a whole. That is very important on your group underwriting. They do not do individual underwriting. Cost of coverage is based on the average age of the group and the ratio of men to women in the group. Evidence of insurability is usually not required because once again, they're underwriting the group as a whole. Next, an association could purchase group health insurance for its members, but here's some of the rules for the association. First, the association must have at least 100 members, at least 100 members, at least 100 members, at least 100 members. All right. Now, what do you think is important about an association? You would be correct if you said at least 100 members. Now, there's other rules. They have to have a constitution, bylaws, and hold annual meetings. But I promise you, on your test, where they will try and trick you is the at least 100 members. Now, remember, with your group health, you as an employee do not own the plan. It's owned by the company. So the employer gets a master policy. Employees do not get a policy. What you do get are certificates of insurance. That's really important for your test, by the way. Now, if you leave your employer, you have a conversion privilege. You have 31 days to convert without proof of insurability to an individual plan. Now, if you do have pre-existing conditions and you want to convert, you cannot be declined, okay, because you're doing it without evidence of insurability. However, the insurer can evaluate you so that if you do have pre-existing conditions, two things could happen. Number one, you could get lesser benefits than what you had in the group plan. And number two, you could get rated up, paying a higher premium. Okay, so that is the conversion privilege. Going to an individual plan without evidence of insurability within 31 days, but you could get rated up and get lesser benefits. Now let's look at how that conversion privilege differs from COBRA. COBRA, which is the Consolidated Omnibus Budget Reconciliation Act of 1985, that is federal legislation. Now there's a lot of numbers here in COBRA that I need you to know. First, COBRA applies to employers with 20 or more employees to extend group health coverage to terminate employees and their families after a qualifying event. Qualifying events under COBRA are voluntary termination of employment for reasons other than gross misconduct, such as company downsizing, or employment status change from full-time to part-time. So those are the qualifying events under COBRA. For any of these qualifying events, the employee has 60 days to exercise their extension to COBRA, and then it must provide coverage for up to 18 months. Now, the maximum time period for COBRA is 36 months, but it is specific to Death of the employee, then the family can stay on COBRA for up to 36 months. Divorce, then the old ex can stay on COBRA for up to 36 months. Or in states that actually have legal separation, the legally separated spouse can stay on COBRA for up to 36 months. Now remember, with COBRA, you are staying on the group plan. So the employer is going to be collecting the premium. The employer can only charge an extra 2% to cover administrative cost over whatever the total premium was before in the group plan. So let's take a look at that. Let's say you're the employee and you've been paying $250 a month for your health coverage, pretty affordable. What you don't know is behind the scenes, your employer has been paying $750 a month, okay, for a total of $1,000 a month. You have a qualifying event, you want to get on COBRA. You get a letter from the insurance company that says, welcome to COBRA. Your new monthly premium will be $1,020 a month. And you're like, how in the Hades did it go from $250 up to $1,020? Well, it's whatever you were paying. Now the employer ain't going to pick up his part anymore. You're going to have to pay that for a total of $1,000 a month. Add an extra 2%. That's how you get to $1,020. Okay. And lastly, in this chapter, some limited benefit plans. Get back to kind of our AFLAC type policies. They're limited to whatever benefits they say they will provide. First would be like a dread disease plan, like a cancer policy or a heart disease policy. It would only cover that specific dread disease. There are critical illness plans, which would pay a lump sum for the diagnosis and survival of a critical illness. Hospital indemnity plans, that brings us back to our basic hospital expense policy where it paid a specific dollar amount per day for your room and board while you're confined to the hospital, but it had a limited number of days it would pay. There's short-term medical plans, which could cover you for up to 11 months after you leave an employer. Accident-only plans obviously would only cover accidents. Then you have dental, covering dental, and vision, covering vision. But you do need to know on both of these that because of the Affordable Care Act, pediatric dental must be covered under all dental plans, and pediatric vision must be covered under all vision plans. All right, that is your types of health policies. Now go to your simulator and begin practicing.